Welcome to Clever Money Hacks, the channel where money moves and life improves. In today's episode, we'll be discussing, well, the man Wall Street fears most.
And judging by the absolute sea of red on the charts yesterday, fear might be too soft a word. That was panic.
Yeah, we need to address the elephant in the room immediately. It is Saturday, January 31st, 2026. And if you, the listener, decided to check your brokerage account yesterday, I'm so sorry. Because that was brutal. We saw gold drop, what was it, 11%?
11% in a single trading session. And silver crashed 33%.
33. I mean, usually commodities like that are the safe haven to
Yeah, it's supposed to be.
That's not a correction. That feels like a fire sale.
It was a liquidation event. It was basically everyone was selling everything just to get cash. And it all traces back to one headline that dropped yesterday morning.
The big one.
President Trump has officially confirmed Kevin Warsh as the new chairman of the Federal Reserve.
Which, on the surface, feels completely backwards. We know Trump measures his success by the stock market. He loves all-time highs.
He tweets about the Dow Jones like it's a sports score.
Exactly. So why in the world would he appoint Kevin Warsh? This guy isn't known for pumping up the market. He's known for, popping bubbles.
It feels like hiring a firefighter to run a fireworks factory.
Right.
It makes no sense.
It does seem like a massive contradiction if you only look at the stock market. But here's the thing. Trump isn't looking at the stock market right now.
Oh.
He's staring at a much bigger, much scarier bomb that is ticking away in the bond market. And he thinks Warsh is the only one who can defuse it before it blows up the entire government.
Okay, that sounds ominous. But before we get to the exploding government part, let's back up. Who is Kevin Warsh?
Right.
I feel like I've heard the name, but he's not exactly a household celebrity like Yellen or Powell. You've described him in our notes as the anti-academic. What does that mean?
So you have to imagine the Federal Reserve back in, say, 2006. It's a very specific vibe. Okay, set the scene.
You walk into the room, and it's filled with 60-year-old PhDs people like Ben Bernanke, Janet Yellen.
The ivory tower.
Totally. They have spent their entire careers in universities. They live in the world of theoretical models and econometrics.
Lots of chalkboards and theories about how the world should work.
Exactly. And then the door kicks open, and in walks Kevin Warsh. He's 35 years old.
Okay.
He doesn't have a PhD. He's a former mergers and acquisitions banker from Wall Street.
So a completely different animal.
The source material has this great line. It says he walked in there smelling like trading floor tobacco.
I love that.
Yeah.
So he wasn't there to talk about economic theory.
He was there to talk about price.
Okay.
About what was actually happening.
Okay, but isn't that a bit, I don't know, arrogant? You have all these seasoned economists, and this 35-year-old banker walks in to tell him what's what. Did they even listen to him?
At first, no, not really. They largely ignored him. But there's this famous story from 2006 that really defines who he is. The PhDs are sitting around the table looking at their models, and they're saying, the data looks fine. The housing market is robust. The economy is strong.
Which we know now was, well, not true.
Yeah.
At all.
Right. And Warsh raises his hand and basically says, I'm sorry, but I just got off the phone with a few CEOs on Wall Street. He specifically mentioned firms like Lehman Brothers and Bear Stearns. He told the Fed, these guys are telling me their cash positions are drying up. The plumbing is getting clogged.
So real-time intel.
Real time. He said they only have enough cash to survive a few days. He was getting intel from the trenches while the rest of the Fed was, reading yesterday's newspaper.
That's the perfect way to put it. So he warned them months before the collapse.
He did. But because he didn't speak their language, he didn't present it as a peer-reviewed paper. They dismissed it. And we all know how that turned out in 2008.
Okay, so he gets credit for predicting the crash. That's impressive. But usually, if someone predicts a crash, the market loves them. Why are investors terrified of him now?
It's not his personality. It's his philosophy on how you fix a crisis. So fast forward to 2010.
Okay.
The crisis is technically over, and Ben Bernanke is getting ready to launch QE2 quantitative easing.
Money printing.
Basically, printing more money to boost the economy. Wall Street loved this. Free money is great for stock prices.
Sure, who doesn't love free money?
Kevin Warsh doesn't. He stood up and publicly opposed it. He wrote an op-ed in the Wall Street Journal that is being circulated everywhere today.
What did he say?
He wrote regarding the economy, save the patient, but now we are feeding poison.
Feeding poison. That is a strong choice of words for a central banker.
He viewed low interest rates and money printing as an addiction. He argued that, yes, you give a patient morphine when they break their leg in a car crash. That was 2008.
Right, an emergency measure.
But you don't keep them on the morphine for 10 years after the leg heals. If you do, you turn them into an addict.
And if we look at the U.S. economy today, in January 2026,
The patient is 400 pounds and addicted to the ventilator. The economy can barely function without the promise of easy money.
wow.
So the market is terrified because the man who called this poison 15 years ago is now the doctor in charge. And he's not here to refill the prescription
He is here to pull the plug.
and force the patient to go through rehab. And rehab is painful.
That explains the stock drop. But there's another layer here. This guy isn't just a theorist. He's got the bank account to back it up.
That is a crucial under-discussed detail. Warsh married into the Estee Lauder family.
The cosmetics fortune.
Right. We are talking about billions of dollars in net worth. In Washington, D.C., the most dangerous person is a wealthy official who does not need the job.
Because you can't fire them. Or you can't bribe them.
Both. He has what they call FU money.
FU money, right.
He cannot be bullied by politicians who want a rate cut to help their poll numbers. And he certainly won't be bullied by a stock market throwing a tantrum.
So if the S&P 500 drops 20%,
Most Fed chairs panic because they want to keep their job. Warsh. He can just go home to his billions. That independence makes him incredibly unpredictable.
so we have a wealthy, stubborn guy who hates money printing.
Mm-hmm.
That explains the fear. But let's go back to the paradox. Why did Trump pick him?
Right?
Trump loves low rates. He loves the rocket ship stock market. Why pick the one guy who wants to shut the party down?
This brings us to the why. And to understand it, we have to talk about a group of people called the bond vigilantes.
Bond vigilantes.
Yeah.
It sounds like a bad Western movie. Who are these guys?
Yeah.
Are they actual people?
They're the unseen enforcers of the global financial world. It's just a term for the massive global investors, pension funds, sovereign wealth funds, central banks who buy government debt.
Oh,
Usually they are passive. They just buy the bonds and collect the interest. But when they think a government is spending recklessly or printing too much money, they go on strike.
on strike, meaning they just stop buying the debt.
Correct. And when they stop buying, the government has to offer higher and higher interest rates just to bribe them back. This sends yields skyrocketing.
And this isn't a theory, right? The sources mentioned something called a nightmare scenario that happened just last year, back in August 2025.
That was the warning shot that woke Trump up. On August 6, 2025, the U.S. Treasury held a routine auction to sell $42 billion in 10-year debt.
Basically, the U.S. needed a loan.
Alone. And usually foreign buyers scoop up about 88% of that debt without blinking. But on that Wednesday, they only bought 64%.
Whoa. That is a massive drop. So almost half the people who were supposed to show up to the party just ghosted.
Exactly. And here's where it gets embarrassing. When nobody buys the debt, there's a fail-safe called primary dealers,
The big U.S. bank.
JP Morgan, Goldman, etc., that are legally required to bid if no one else does. They were forced to step in and swallow the bad debt to save the auction from failing completely.
So it's like throwing a dinner party. Nobody comes, so you force your catering staff to sit down and eat all the food so it doesn't look like a disaster.
That is a perfect analogy, and the world noticed. It was a humiliation for the Treasury. And Trump is looking at the math.
What's the math?
The U.S. national debt is now sitting at $38.5 trillion. But the scary number is the interest. In 2025, just paying the interest on that debt cost us $1.16 trillion.
Hold on, I need to frame that number. $1.16 trillion just in interest. How does that compare to, say, the military?
It's bigger. We are now spending more to pay our bondholders than we are to fund the Army, Navy, Air Force, and Marines combined.
That's insane.
And that was at current rates. If the bond vigilantes truly revolt and push yields up to, say, 6%, the U.S. government becomes insolvent, the interest payments would eat up a third of all tax revenue.
Okay, that clicks. So Trump is looking at a choice. Either the stock market takes a hit or the entire U.S. government goes broke.
Precisely. He fears the bond market more than he loves the stock market. If bond yields spike, the game is over. The dollar collapses.
So Kevin Warsh is his peace offering.
It's a signal. By hiring the most hawkish anti-inflation hardliner available, Trump is telling the bond market, look, we are serious now. We're going to stop the printing. Please keep buying our debt.
So Warsh is the sacrificial lamb. Or no, the stock market is the sacrifice. Warsh is the executioner.
Correct. Warsh is being sent in to restore credibility, even if he has to burn the stock market down to do it.
All right, let's talk about the burning down part. The outline calls this section the Warsh Doctrine. If he's really going to pull the plug, what does that actually look like for companies?
His philosophy boils down to two concepts that sound pretty brutal: killing zombies and cutting tumors.
Let's start with the zombies. I assume we aren't talking about the undead.
We're talking about zombie companies. These are businesses that only exist because money has been free for the last 15 years.
So they don't actually make a profit.
No. They survive by borrowing more cheap money to pay off their old cheap money.
The sources mention Rivian, the electric truck company, as an example here. Now, I see Rivian's on the road. They make a real product. Why are they a zombie in this context?
It's about the math of their valuation. Rivian represents the growth at all costs model. When interest rates are at 0%, investors are willing to say, hey, you might not make a profit until 2035, but that's fine, I'll wait.
Right.
But Warsh believes in higher for longer rates. If rates sit at 5%, the math changes completely because of something called discounted cash flow.
Okay, pause. Discounted cash flow.
Yeah.
That sounds like MBA jargon. Break that down for us regular people.
Think of it this way. If I offer you $100 today or $100 10 years from now, you take it today, right?
Obviously.
But what if I say, I'll give you 110 years, or I can give you $10 today and you can put it in a bank account that pays 20% interest? Suddenly that cash today is really valuable because it can grow.
Ah, I see.
When interest rates are high, money now is worth way more than money later. So for a company like Rivian that promises all its money in the distant future, a high interest rate makes those future dollars nearly worthless in today's terms.
So their stock price goes from based on 2035 dreams to based on 2026 reality.
And the reality for many of these companies is that they are losing money. Warsh views bankruptcy not as a failure, but as a cleaning agent.
A cleaning agent.
He believes capitalism needs forest fires to clear out the dead wood. If you don't let the garbage companies die, the good companies can't grow. He's going to let the zombies starve.
Man, that is harsh. People lose their jobs in those bankruptcies.
And that brings us to the second part, cutting tumors. The tumor is inflation. Warsh treats inflation like cancer.
Okay.
The previous administration, and specifically Jerome Powell, tried what Warsh would call palliative care. They raised rates a bit, but they always promised to cut them soon. They were trying to manage the pain.
And war.
Warsh believes in chemotherapy.
And anyone who has dealt with chemo knows it attacks the good cells along with the bad. It creates a recession.
A painful one. That's the hair falling out phase. But Warsh's view is that if you don't do the chemo, the patient, the currency, dies. He is willing to cause recession to kill inflation once and for all.
But I have to push back here. A painful recession isn't just lines on a chart. It's people losing homes, small businesses closing. Is he really willing to inflict that kind of misery just to balance his spreadsheet?
In his view, the alternative is worse. If the dollar collapses because of the debt, everyone loses everything. Your savings become worthless. So he sees it as a necessary evil.
Which is incredibly risky for Trump politically.
Hugely. But there's a plan for that.
Right. Trump wants to be popular. How does he plan to survive a recession that his guy caused?
This is what the strategists are calling the four-year play. You have to look at Trump's second term as two distinct halves.
Okay.
Years 1 and 2, 2025 and 2026 are the detox.
So let Warsh crash the market now, early in the term.
Exactly. If the market crashes in 2026, Trump doesn't take the blame. He blames the mess left by Biden and Powell.
Ah, the classic move.
He tweets that Warsh is doing a fantastic job cleaning up the disaster and that the pain is necessary to make America healthy again. He externalizes all the blame.
Cynical, but I see the logic. Get the bad news out of the way early.
Then we get to years 3 and 4, 2027 and 2028. By then, ideally, inflation is dead. The zombies have gone bankrupt. The economy is clean.
And a recovery starts.
An organic boom just in time for the midterm elections. Trump takes all the credit for the recovery.
It's a huge gamble, but it means the next 18 to 24 months are going to be a minefield for investors.
A minefield is right. And you need to understand that the Fed put is likely dead.
The Fed put? That's the idea that the Fed will save the stock market if it drops too much, right?
Yes. For the last 15 years, if the NASDAQ dropped 10%, the Fed chair would come out and say something soothing, maybe hint at a rate cut.
The market's safety net.
And with Warsh, imagine the NASDAQ drops 10% tomorrow. Powell would hold a press conference. Warsh. He'd likely publish a cold op-ed saying, Price discovery is normal. We are a central bank, not a hedge fund.
He will let it burn.
He will let it burn.
Okay, that is scary. The safety net is gone.
Mm-hmm.
Buy the dip might be terrible advice now.
Hmm.
So let's get practical. If the rules have changed, how do we survive? The source material mentions a survival guide called the Warsh filter.
Right. This is the most important takeaway for today. Before you buy any stock or even keep holding what you have, you need to run it through 3 tests.
Okay, I'm ready. I'm looking at a popular tech stock. How do I apply test number 1?
The debt test. You open their income statement, you look at one specific line, interest expense, then you look at net profit. Is the amount they pay in interest higher than the profit they actually make?
And if the answer is yes,
Then it's a zombie. In Warsh's world, they will not get a bailout. When their debt comes due, they go bankrupt. Put it down, don't touch it.
okay, test number 2. Let's say the company passes the debt test. They have some cash. What's next?
The pricing power test. This is about inflation. Ask yourself, can this company raise its prices by 10% tomorrow and keep its customers?
So like Apple.
Apple is the perfect example. If the iPhone costs $100 more, people grumble, but they still buy it. Now think about a generic clothing brand at the mall. If they raise prices 10%, you just go to the store next door.
So if they don't have pricing power, inflation eats their lunch.
Exactly. High rates and inflation crush their margins. If they can't pass the cost to the consumer, they die.
Got it. And the final test, test number 3.
The sucker test. This one hurts to look at. Look at the chart for the last 3 years. Is the company's profit actually rising, or is just the stock price rising?
Ooh, the hype train.
If the stock is up 50% but profits are flat, you are betting on finding a greater fool to buy it from you at a higher price. In a liquidity crunch, which is what Warsh brings, the fools disappear.
And you're left holding the bag.
You're left holding the bag.
So who actually passes these tests? Because it sounds like you just described 90% of the S&P 500 failing.
You're not wrong. The winners here are the cash kings. Companies sitting on massive piles of cash, like the big energy giants or legacy tech like Apple.
Why them?
Think about it. If Warsh keeps rates at 5%, Apple earns 5% on its cash pile without doing anything. Plus, when their competitors go bankrupt, they can buy up the assets for pennies on the dollar.
So we're moving from an era of growth at all costs to cash is king.
Exactly. Defensive is the new offensive.
Now, we've been assuming Warsh succeeds, but the future isn't written. The expert in our notes outlined 3 possible paths forward. What are we looking at?
Right. Path A is what we've been discussing. Warsh wins. He keeps rates high, zombies die, we have a short, sharp recession, and then long-term health. The dollar gets stronger.
And the advice is to position for that.
Because it's the most survivable strategy. But there's path B, the fold. The pain gets too great, the market crashes maybe 40%, unemployment spikes, and Trump panics.
And he fires Warsh.
He fires Warsh or bullies him into submission. The money printer turns back on.
And if that happens?
Hyperinflation or stagflation. The credibility is gone. The dollar loses all trust. In that scenario, you'd want gold and Bitcoin.
Right. And finally, path C.
The accident. This is the scariest one. Warsh is too aggressive. Something in the financial plumbing breaks, like the repo market, but worse. A major bank fails. We get a sudden, catastrophic financial crisis.
And in that case, they have to pivot, just keep the lights on.
Exactly. But it would be chaos. It sounded like yesterday's market volatility was the market trying to figure out which of these 3 paths we're on.
It feels like the era of the nanny Fed is over. We are entering a period of true capitalism, which means real risk and real consequences.
It does. And it really makes you think. We've all been complaining about inflation for years. The cost of groceries, rent, everything.
Of course.
Now, we have a guy who is willing to actually fix it, but the cure might hurt more than the disease in the short term. It's a tough question.
A very tough question for everyone listening.
It is. Are we willing to accept a recession to save the dollar? Or have we become so addicted to the cheap cash that we'll scream for the morphine until the system collapses? Kevin Warsh has made his choice. Now we have to see if the country can stomach it.
That is a heavy thought to leave us with. But I guess the takeaway is, don't panic. Just prepare. Check your portfolio against that Warsh filter.
Absolutely. Survival first, growth second.
Thank you for listening to today's episode. And don't forget to like, subscribe, and share your ideas for future episodes. See you next time.